Welcome to TalkTickers. We're your shortcut for getting up to speed on key earnings calls.
And today, we're diving into S&P Global's latest results.
That's right. They just reported their first quarter, and broadly speaking, it looked pretty strong.
Yeah, solid performance, growth pretty much across all their different divisions.
So we'll unpack those key financials, look at some pretty big strategic moves they announced.
Definitely some big news there.
And also get into what they're expecting for the rest of the year.
Okay, so Q1, overall revenue, it was up 8% compared to last year.
8%, okay. And subscriptions were a key part of that.
Exactly. Subscription revenue grew 7%. Yeah. And importantly, they also managed to expand their margins.
Right. I saw that. 100 basis points year over year.
Yep, 100 basis points. So profitability improved too.
And that flowed through to the bottom line. Earnings per share.
It did. Adjusted diluted EPS, that was up 9% year over year.
Nice. And shareholder returns. Always something people look for.
They were active there too. Returned over $900 million in Q1 alone.
Wow. Through dividends and share buybacks.
That's the mix, yeah. Dividends and repurchases.
Okay, so that's Q1. Pretty solid picture. What about looking forward? The guidance for the full year. Sounds like there were some tweaks.
There were. They're now calling for revenue growth between 4% and 6% for the full year.
Okay. Bit lower than some might have hoped.
Possibly, yeah. And adjusted margins are now expected between 48.5% and 49.5%.
Right. And EPS?
The adjusted diluted EPS range is now $16.75 to $17.25. So they slightly widened the range there as well. We can get into the reasons why.
Definitely. Let's dig into that. But first, those strategic moves you mentioned. Pretty significant news.
Huge news, really. The big one is their plan to separate the mobility division.
Spin it off.
Yeah, into its own publicly traded company. They're aiming to do that within the next 12 to 18 months.
And it's expected to be tax-free.
That's the plan, yes. Tax-free spinoff allows both companies to really focus,
Makes sense. Mobility focuses on automotive data. S&P Core focuses on financial.
Exactly. And alongside that, they're also selling their OTRA joint venture.
OTRA, Operational Transaction Reporting Analytics.
That's the one, selling it to KKR. That should close in the second half of this year.
So quite a bit of portfolio shaping happening.
For sure. And they've scheduled an investor day for November 13th to lay out the strategy post-mobility separation.
Okay, good to know. Now, how are the sort of broader market conditions playing into all this? Build issuance, for instance. That's key for ratings.
Right. So Q1 actually saw a decent increase in build issuance, up 9% year over year.
What drove that?
Mostly structured finance and bank loan activity. Refinancing was quite active.
But they don't expect that pace to continue.
No, they're expecting it to moderate through the rest of 2025. They even mentioned seeing a dip in April already.
Oh, interesting. Any reason cited?
They mentioned maybe tariff discussions, just general market volatility kind of weighing on things.
So the full year outlook for build issuance is now?
Approximately flat compared to last year. That's the current expectation.
Okay. And how's customer engagement looking amidst this maybe uncertainty? Are people still using their platforms?
Actually, yeah. Engagement seems really strong. Active users across platforms like Capital IQ, Platts Connect, Automotive Mastermind.
The big ones.
Yeah, they were up an average of 23% year over year in Q1.
23%, that's huge.
It is. And they said that strong engagement continued into April too.
But on the flip side, are customers making decisions more slowly?
Less M&A confidence.
That's what S&P is observing, yes.
Yeah.
A kind of slowing pace in decision making and maybe less certainty about when or how big an M&A recovery might be this year.
So in that kind of environment, that recurring revenue base must be pretty crucial.
Absolutely essential. It's about 75% of their total revenue.
Provides a nice cushion.
Definitely.
Yeah.
Gives them resilience. And interestingly, market volatility isn't always bad for them.
Right. Some parts of the business actually benefit. Exactly. Things like their exchange-traded derivatives, the indices business, global trading services, commodity insights. Volatility can actually drive activity there.
Okay, let's break down the divisions then. Market intelligence revenue up 5%. What were the highlights there?
Within MI, data analytics and insights products, they actually accelerated, up 7% reported, 4% organic.
Okay.
Enterprise solutions did well too, helped by that issuance activity we mentioned and good subscription growth. Credit and risk solutions were up 6%.
And margins?
Margins came in at 32.8%, a bit better than expected, actually. And they think revenue growth there will modestly improve each quarter through the year.
Got it. Now, Ratings. Revenue up 8%, even with that mixed issuance picture.
Yeah, positive growth across all categories there.
Yeah.
Transaction revenue, which is tied to issuance, was up 7%.
Driven by that Q1 refinancing activity.
Primarily, yeah. Bank loans, structured finance, but non-transaction revenue was even stronger, up 10%.
What's in non-transaction? Annual fees?
Annual fees, surveillance fees, ICR revenue, especially from private markets, that was a highlight.
And the outlook for ratings, given the flat issuance view.
They expect billed issuance to be down maybe low double digits in Q2, then flattish in the second half.
So transaction revenue likely takes a hit.
Yeah, that's the expectation. They think non-transaction revenue will probably grow faster than transaction revenue for the full year in ratings.
Okay. Commodity Insight seems like a real bright spot. It's up 9%.
Yeah, another strong quarter. That's actually their sixth consecutive quarter of double-digit growth in energy and resource data and insights.
Wow. What specific areas?
Price assessments grew 8%, data and insights up 10%, advisory and transactional services jumped 19%.
19%.
Yeah, helped by record performance in global trading services and also record attendance at their big energy conference, Sarah Week.
Anything lagging?
Upstream data and insights grew only 1%. They mentioned customer consolidation in the energy sector, kind of tempering that a bit.
And margins in commodities.
Improved nicely, up to 48.1%. Very healthy.
Okay, mobility. The division they're spinning off, how to do? Up 9%.
Yep, 9% revenue growth. And that includes a bit of a currency headwind.
What drove it? Dealers.
Dealer revenue was strong, up 11%, driven by Carfax and Automotive Mastermind.
Makes sense. Manufacturing?
That was slower, up only 1%. They said a decline in recall-related transaction revenue impacted that.
Okay.
Financials and other segments within mobility grew 11%, and they highlighted user growth for Carfax Care, now 46 million users.
46 million, impressive. And mobility margins.
Also improved, up to 38.5%.
Right. Last division. S&P Dow Jones Indices, up 15%.
That's strong.
Very strong, mostly driven by asset-linked fees. They were up 18%.
Tied to AUM and ETFs and funds.
Exactly. Higher average AUM really helped there. Plus, continued strength in exchange-traded derivative revenue. That was up 11%.
What about data subscriptions?
Data and custom subs grew 7%, mostly driven by end-of-day contracts.
And indices margins are always eye-watering.
Still are, 72.9%, though they do caution that the growth in those asset-linked fees will probably moderate a bit going forward. Okay, so pulling it all together, let's revisit that updated full-year guidance. Remind us of the key changes.
Sure. Total revenue growth, now 4.6%. Adjusted margin, 49.5%
And that margin revision is partly due to the OTRA sale and mix shift.
That's right. And adjusted diluted EPS, the range widens slightly to $16.75, $17.25.
And the divisional guidance changes really reflect those market views, right?
Exactly. Ratings revenue growth now seen flat to up 4% because of the flat billed issuance expectation.
Oh.
And indices revenue growth revised down a bit to 5.7%, reflecting, the recent market pullback.
But market intelligence, commodity insights, mobility guidance unchanged for those.
Correct. Guidance remains the same for those three.
And they still expect to hit their margin targets for all divisions.
They reiterated the margin outlook for all five, yeah. Pointing to expense discipline, maybe some adjustments to incentive comp, if needed.
Speaking of costs, how are they managing expenses generally?
They said they're actively monitoring things like headcount, hiring, incentive pay, third-party spend, really looking closely given the issuance environment.
But still investing in growth.
Yeah, prioritizing strategic growth investments.
Yeah.
And they mentioned ongoing cost-saving efforts, too, like removing silos in market intelligence and using Gen AI for productivity and commodity insights.
Interesting. What about other growth areas? Innovation.
They called out sustainability and energy transition revenue that grew 20%.
20%. Strong?
And private markets revenue also very strong, up 21%.
Seems like those are definitely key focus areas.
For sure. And those IHS market acquisition synergies, they're tracking ahead of plan, reached a $311 million annual run rate already.
Ahead of the $350 million target for 2026.
Yep. And in terms of new stuff, they mentioned integrating visible alpha data into Capital IQ Pro, launching an AI tool for automated data ingestion called IE.
ILE.
Yeah, and also new fixed income and commodity benchmarks. So innovation seems ongoing.
Okay. So putting it all together for someone tracking S&P Global, what's the kind of big picture takeaway here?
Well, I think the mobility spinoff is obviously huge news. It signals a real sharpening of focus on the core data and analytics financial information businesses.
Letting both entities maybe pursue growth more effectively.
That seems to be the idea. The revised guidance, though, it does reflect some caution, especially around those market-sensitive areas like ratings and indices. Equity markets, build issuance expectations. They're being realistic there.
But the underlying subscription business is holding up well.
Absolutely. That resilience is key. And you see the continued investment in innovation AI, new data tools. They're clearly focused on staying ahead.
And the growth in areas like sustainability, private markets,
Yeah.
that reflects where the demand is going.
Definitely aligns with broader market trends. Shows they're positioning themselves in those growing spaces.
Okay, great overview. Now let's shift gears slightly to our This Is Not Financial Advice segment. Time for an outrageous but plausible trade idea.
All right. So, thinking about that mobility spinoff, here's an idea. Consider a long position in the new mobility company once it actually starts trading.
Okay, go on. Why long the spinoff?
Well, think about it. It's a significant business, over $1.6 billion in revenue, nearly 40% adjusted margin.
Right.
And crucially, over 70% of its revenue comes from the used car market, mostly via Carfax, right? And over 80% of its total revenue is recurring, subscription-based.
So more stable than new car sales, maybe? Less cyclical?
Potentially, yeah. More insulated from, say, new car volatility or tariff impacts. Plus, you've got growth potential in things like Carfax Care usership.
And the outrageous part, or the plausible part.
The plausible part is the solid underlying business. The potentially outrageous part is betting that the market might initially undervalue it. You know, spinoffs can be messy, sometimes overlooked initially.
So the idea is to get in if it seems cheap right after the spin.
Kind of, yeah. Assuming the spinoff happens smoothly within that 12, 18-month window, of course. It's an idea to watch.
Interesting angle. Again, not financial advice, just an idea to mull over. So let's wrap up our deep dive on S&P Global.
Okay, so S&P Global put up a solid Q1. Good revenue, good earnings growth.
Right, and made some major strategic announcements, especially that mobility separation.
Yeah, that's the big one structurally. They acknowledge some near-term headwinds issuance equity markets, but seem confident overall, leaning on that strong subscription base and innovation pipeline.
The outlook is a bit more cautious, but the foundation seems solid.
Exactly. And that mobility spinoff really changes the shape of the company going forward. Lots to watch there for both S&P Core and the new mobility entity.
Definitely. And maybe a final thought for you, the listener, to consider. With S&P Global sharpening its focus on core financial data after the mobility spinoff, how might that impact their ability to innovate specifically within those financial markets?
Does increased focus lead to deeper breakthroughs? Or could they potentially miss out on broader cross-industry data synergies they might have seen before? Something to think about.
Indeed. Thanks for tuning in to TalkTickers. Remember, this isn't financial advice.